Paul, thanks for taking the time to join us this morning. Paul, we've been seeing builds in the EIA coming in week after week now. I think it's 3 in a row. Cushing, Oklahoma, actually had its first build since December of last year yesterday. Now, I'm curious, with all the builds that we're seeing, with all the supply, where does this leave OPEC in their efforts to reduce inventory levels?
It's going to be hard because I think actually the projections are for this year for the United States to actually outstrip OPEC as far as production and additions to supply. Right now, we are expected to export more crude than we have any time since the 1960s. So the balance of power, if you will, in the oil and the energy market is really now shifting to the United States and away from OPEC. And we will be, I think, a little bit more in control of those prices going forward.
Good morning, Paul. I have a quick question for you as someone who watches the oil market on a daily basis. Now, just like in the financial markets, the headlines are always the inventories, right? Crude oil levels up this, crude oil levels down this. What's the next thing that you watch? Give our listeners an idea of what is the secondary data point that you watch when concerned to crude oil.
You know, what's interesting is there's a couple of the kind of outlier type of things that we'll take a look at. We take a look at total amount of miles driven for vehicles. That's been coming down, and we're seeing more efficiency in autos. The other thing is there's a seasonality to energy prices at the pump, and we see that peaking out in this window between here and early part of May. And then we see that slide through August into September. So we want to take a look at those seasonal patterns and make sure that they're still lying on top of each other. And so far, that's been the case. We've seen a little increase in the price of energy here coming into the first quarter. That's consistent with history. We should see it peak out here in the next 4 to 6 weeks, and then we'll see it slide through the summer months. So we want to take a look at those seasonal patterns and make sure that they're still pretty strong.
All right, let's talk about the dollar correlation, because that's one of the things that we look at here in terms of dollar weakness tends to bring a bit of a bid into the crude. What are your thoughts on that?
You know, it's kind of interesting. The dollar is kind of moving on more political, I think, than it is on the commodity complex or energy or gold. When we start to see the tariffs come up and we're starting to see some changes in Trump's cabinet to a little bit more protectionist talk, we're seeing a bigger impact on the dollar coming from Washington, really, than what we're seeing in any of the complexes, energy, metals, et cetera. So I think really the focus should be more on Washington over the next couple of weeks as far as trying to gauge the dollar direction. Our view is that the dollar is likely to be weaker over the next couple years. They go in long-term cycles. We're year 2 of probably a 5-year down cycle in the dollar here. So we think without the jumps around, we think the dollar's heading lower.
Paul, geopolitics is obviously a big part of trading commodities, especially trading oil. It's such a headline-driven trade. What else do you look at in terms of geopolitics? Like, case in point, is Venezuela really a pretty big deal right now in terms of oil? What about India? What are you looking at in terms of geopolitics and the prices of oil?
You know, really, it's going to come down to, I think, more what we're doing with China. China's been a big user of oil, and they've, at the margin, I think, probably have a little bit more impact on pricing. So I think what we're going to see and be focused on is our relations with China more than anything else. And I think, too, here is where we could see the price of oil pick up if relations between us and China deteriorate. Because that'll force some of those other countries, Venezuela, OPEC, et cetera, to provide that oil to China that we might be doing instead.
Paul, I want to kind of educate our viewers here. If you would inform us on the differences between the crude oil WTI contract and the crude oil Brent contract. We kind of always clump things together when we're talking crude, but here on the show, we're always talking about WTI. What's the difference between the two separate contracts?
WTI is really Cushing, Oklahoma, and that is very U.S.-centric. Both Brent and WTI are light sweet crude, so they're pretty comparable as far as product goes. But WTI is really U.S., and that's impacted more by our own production, and certainly since we've picked that up dramatically over the last 5 or 6 years. We've seen that spread widen out. Brent is probably better an indicator of global oil demand and will move more with global demand. Look at WTI, though, more local, and Brent more global.
Understood.
Hey, Paul, let's go to the demand side now. The new numbers from IEA came out 99.3. Was that the number you guys were looking for? Did that come in? What were the expectations on that demand number out of IEA?
You know, the demand number gets adjusted around an awful lot. That was pretty close to what our numbers were. You know, we're seeing those adjustments more on the downside than the upside. So we're looking more at demand coming off than we are seeing it really pick up dramatically. So our expectations, and that's part of the reason why we're calling for generally stable to lower crude prices, because supply is still very bountiful. Demand is not picking up as quickly as supply, and that's been kind of the dynamic for a while. So if you take a look at history, we're building more supply, and we're at the upper end of, say, the 5-year band or average supply that we're holding. We're toward the upper end of that 5-year range right now, and we think we're going to stay there, and that's going to keep pressure on energy prices, I think, through the summer months here.
Big time. Now that's demand, and I start to think about demand, and I hear a lot of talk, Paul, about concerns as far as research and development of crude. After seeing crude at these lower levels here, it seemed like, for the most part, companies were really shutting down that exploratory venture. But are we in a situation where the production and the research and development is actually now behind the demand curve, and should we expect to see a little bit of a pinch in the crude market as a direct result of that?
You know, it's going to take probably another year before that works its way through the system. We heard about a lot of those shutdowns when we got crude down below 30, and we've heard a lot about all of that. The rig count has picked up here. It's flattened out around the 950